Good afternoon, everybody. Welcome to the next in the series. I guess we're calling this the financial planning series. There was already, I think they called it accounts, budgeting, and credit back in October. Today we're going to talk about home buying. As I mentioned earlier, this is enough to get everyone dangerous. Probably won't be able to answer all your questions, but I want you to understand the process. I am going to come back for a tax talk early in the year. That's always a fun one. And then we have a couple others, as you can see, throughout the spring. So without further ado, we're going to jump right into home buying. You're going to see lots of quotes by it. This is my own. It's not that you break it, you bought it, but if you bought it, it will break. It's one of the downsides of being a homeowner. So when you're looking ahead, whether it's this year or some year in the future, when you're trying to decide, okay, should I be buying a house or not, what are some of the things you might consider? Biggest one is it affordable? And as having this conversation earlier, you have to live somewhere. So there's a cost to wherever you're living anyways. You're probably paying rent or things like that. So when we're looking to buy, we have to compare it towards what's the alternative. Also, geographic aspects pay into a place if it's affordable or not. If anyone is here from the Bay Area in California, New York City, the Beltway area in DC, Boston, things like that, affordability plays a huge role in how much house you could afford or whether you could be a homeowner or not. If we come from very rural locations, land, housing is a lot cheaper, but then again, are we there or not? So your career is going to dictate your location to a certain extent. That location is going to dictate affordability or not. This is a big concept that people always don't necessarily think about. What's the length of time you're going to be in that location? Your career could move you if you're joining a career that is very, very portable from a skill set, and we work for a large employer, they could move you. If we're entering a career where there's lots of layoffs or things like that, you might have to move on or something like that, what's the likelihood of staying in one location? My rule of thumb is 4 or more years. Makes it feasible to be a homeowner versus renting, potentially. But you need to think about how long we're going to be in that location. How soon until you outgrow it? That's another way of thinking about it. If we're starting a family, or if we haven't started a family yet, the typical house that we look at is suitable for you and your spouse, partner, or so forth. But once we start having a family, that house starts to feel really, really small. Also, if we were renting, we now need to rent a bigger place anyways. That puts you into the price range of possibly buying. So think about career, location, family size, and when we may need to move on, so to speak, because we've outgrown the first house. Is it move-in condition? Location's one thing, it's convenient and everything like that, but as soon as you move in, what is that property going to need? Is it going to need new carpets? Is it going to need repairs, broken windows, insulation, new roof, new appliances, and so forth? So we talk about affordability. You'll see a lot of mortgage calculators online, and the realtor and everyone else is giving you a number, says, oh, you can afford this. But then you have to look at the property and say, what else isn't being covered by that affordability? My wife and I, we live in Conshohocken. We've been there probably about, I guess, almost 30 years now. And one of the houses we looked at way back in time, she loved. Location, amenities, everything was perfect. I looked around and saw all the repairs it needed, and I know that was not my skill set. So you have to think about your own skill set, your spouse's or partner's skill set. Is this something that you guys could fix up, or is it something we have to hire to get it to the way you want it? So move-in condition is a consideration. Safety and convenience, obviously, if it has to you have to feel safe in your own home. I don't care how affordable it is, but if it's not safe, we're not going to stay there long. Is it rentable? This doesn't usually come up when you're trying to buy your own personal house. Again, how long are we going to be there? How long until we have to move out of that property? Could we potentially keep it and rent it? Now you're owning it from, let's say, 4 or 5 years. Now you're owning it 7, 8, 9 years, in which case it makes it definitely worthwhile to be an owner rather than a renter. What's our career like? Could we move out of a location because either our career or our family size? Could we still afford to keep the first house and yet move into the second house? So it's lower on the priority, but it's always something to think about when you're buying something. Is it potentially rentable? That single-family house on 3 acres in the suburbs, maybe not is a good rental, but that 1 or 2 bedroom townhome, 1 or 2 bedroom condo is a perfect rental property for someone else to rent down the road. Other considerations. Let's see, are there any tax advantages? The tax law changes after 2017 put a damper on the tax advantages, so you might be reading older material that says, oh, it's always better to be a homeowner for the tax advantages. They still exist, but they've been minimized, and I'll show you an example of that later on. Are home prices rising in that neighborhood? Are they plateaued and have they stayed flat in that neighborhood, or are they falling? Do we really want to buy into an area paying today's price if that location is going to drop over time? Do we want to buy into a location that's on the upswing, where the house will be worth more in the future? Is your income rising? Has it plateaued? Or could it potentially fall over time? I'm going to put some stereotypes out there. Let's say we want to start a family. What happens to our hours worked, potentially? Same time our family expenses are going up, our income could be coming down. Yet we're committed to this home mortgage that we got approved for based on today's income. What's our income look like in the future? Could we still afford to live there? Are we in a work environment, let's say it's very commission-based, sales-oriented, where your income fluctuates significantly from year to year? Did we commit to a house when our income was very high and we have several years of very low? Or are we entering the front end of a career and we project our income to rise in the future? So therefore, if we can afford it now, we can definitely afford it later on. So you have to look at the real estate market, you have to look at your own personal career path as well. What would it cost, and this gets back to the affordability, what would it cost to rent something equivalent? Again, we have to live somewhere. Are we going to pay $1,800 a month to own, whereas we could have rented for $1,200 a month? Maybe, maybe not. If it was equivalent to rents anyways, it's definitely worth considering. Can you maintain it? And again, I talked about my own skill set with maintenance and so forth, but does it have a yard? Do we have to shovel snow? Is there repairs that it needs right away? Is this stuff we could do at home or not? So again, we're buying into something, you own it, you're responsible for it now. Other considerations, which we'll get into more today. Could you qualify to buy it? I'm talking about from a financial standpoint. I'm assuming we all can't write a big $100,000, $200,000 check and buy a house for cash. I'm going to assume we're all going to need to be approved for a mortgage. Could you qualify for that mortgage? I've had plenty of people say, well, my credit score is excellent. Great, that's one factor. The bank or the lender only cares about your ability to repay them next month and every single month thereafter. Your credit score shows them how reliable you were in the past, but not what your financial aspect is going forward. We do need to have verifiable income and assets. May not like my hairstyle, but my hairdresser gets paid a lot of cash. So a lot of that cash does not show up on her tax return. There's what she says her earnings are, and then there's what her earnings actually are. When she goes to apply for a mortgage, she can only show what she's documented, her income. She might have more income. So again, people in cash-based industries have a very hard time qualifying for mortgages. Also, if we're receiving gift money or outside people helping us, that stuff has to be documented. The banks aren't going to take your word for you. The debt-to-income ratio, I'm going to go into more detail on, is rough rules of thumb that the mortgage lenders will put you through to say, okay, if you want to buy this house, it's going to cost X amount per month. Your income, can it support that house payment and all your other financial obligations and still leave money to pay for the day-to-day bills like food and electric, things of that nature. So this all goes into the mortgage approval process. Now, we see a house we like, we see a price on a house, we've been approved for that house. Do you have enough cash to actually buy it? The loan covers the purchase of the house, but there's what they call closing costs. This is the upfront cash involved in order to buy a property. It's everything from a down payment, the taxes on the property, escrows, which you'll hear about, and actually have enough money in your bank account to still pay the next monthly's bills. So the bank will look at your credit score. You have a good score? Great. Then they'll look at your debt-to-income ratio, say, can you afford this house? Great. Then they're going to look at your assets and say, do you have enough for the closing costs? Great. Is there enough left over to pay us our first monthly payment next month? That's pretty much as far as they'll take it. If the answer is yes and they're satisfied, they'll make the loan for you to buy that property. So again, we talked about credit scores, verifiable income. Now, home ownership, there are pros and cons. The pro is it's yours. The con is also it's yours. Anything goes wrong. In the house I've been in for about 20 years now, I've replaced the dishwasher 3 times, refrigerator twice, roof once, water heater once. You know, those stuff comes with being a homeowner. There are potential monthly savings compared to renting, but there's also additional monthly costs with a property. If we're going from an apartment to a house and we're used to that $50 to $70 a month utility bill, and we go to a house, it costs a lot more to heat that house. It costs much more to furnish that house as well. So again, there's monthly savings, there's monthly costs. There are tax savings on being a homeowner and having a mortgage. And there's also costs to sell the property. When you're buying a property, chances are a realtor's involved. The seller pays the realtor. Now that you've bought that property and we want to sell it later on, you have to actually pay the realtor. There's also transfer taxes involved, which is kind of like a sales tax on a property. So there are costs to sell. You can't just move instantaneously. The pro is this is an asset. It's a livable asset. It's a use asset. I never like to think of your home as an investment because it's a utilization. You're actually utilizing that asset, but it is worth something. And over time, hopefully it's worth more. And that means you own it. So you're building what's called home equity or net worth in that house. But the con is that we're kind of stuck with it. If we wanted to move today, we've got to list that house for sale. We have to find someone that's willing to buy it, and it might be months into the future before we can actually sell it. So it's what's called illiquid. You can't access it instantaneously. It could be considered an investment later on. There is equity there. We could utilize that equity to, say, put a kid through college, to invest and so forth. But initially, you have not a lot of equity in the house. Or if we're going to rent it, now it is an asset. We've moved on. We're living somewhere else. Now we're the landlord for once. But you can also lose money on property. Anyone that's lived through 2007 through 2009, the real estate bubble burst, and people lost jobs, and home values actually dropped in a lot of areas. So it doesn't always go straight up. Everyone gives that impression that real estate only goes up. No, it can plateau, it can drop in areas. If you come from, let's say, the Southwest or Florida where they've overdeveloped, and then they'll have boom and bust cycles. Philadelphia is a very kind of a stable area. There's no big swaths of land that are being developed all at once anymore. Now you're going to hear about credit scores. Comes up a lot. I'm not a credit expert, so hopefully you don't hit me with too many credit questions. But you'll hear about, oh, I've got excellent credit, I've got good credit, I've got bad credit, I have poor credit. There are different scales. This is one I just took a snapshot of earlier this week. You might see slight variations in the numbers as to what's considered good or bad. Generally 700 or above, and you will get approved for that loan based on the credit score as long as all your other factors fit. Once we start to get below 700, different banks might have their own criteria as to whether they will or will not lend. Maybe not their best loan, maybe a not so great loan, or what they call subprime or something like that. So the credit score plays a huge role. I didn't put a slide here today. I know I've brought it up in other classes. You should know your credit score before you start the home buying process. You don't want to get too involved and know that, oh, I've got to fix my score now, because the banks aren't going to wait. They're going to move on to the next customer. There are, in your, let's say your credit card statements, your bank statements, they might offer you a free credit score. That's great. Credit Karma, places like that have a Vantage score. Those are all great. Those are good barometers. They're not the most accurate. Banks lend on what's known as a true FICO score. They pay for that score, so therefore FICO only gives it to people that pay. They're not giving that score out for free. Vantage score and the FICO 9 and all these other different scores that credit card, that's a good guess as to what your true FICO score is. If anything, they might be slightly inflated I hate to say it that way. The mortgage lender will run your true credit. It does cost them. They might not charge you for it because they're doing thousands of these a year. If you go to annualcreditreport.com, that gives you your free credit report, not a free score. But a lot of times it says, oh, for $6 get a score or something like that. So if you feel that you might be in the fair to low good category, it might be worth it, to look up your score, the official one. Because you don't want to get turned down because you saw, oh, my credit card statement said I have a 740, but you're really a 680. So it's definitely worthwhile. There's a lot of paperwork involved. So I'm going to go into a couple of the steps involved with applying for a mortgage. You need to have verifiable income. You need to document your income. So the bank or mortgage lender is going to require proof. This could be your W-2s from the past couple years if you have an established work history. Definitely, they want to make sure that you're working now, so they're going to want at least a month's worth of pay stubs. If we've been offered a job in a certain location and we haven't started working there yet, your contract that you've received, a signed contract, could prove what your income will be. Let's see. The hard part with that, let's say we're taking a new job in a new town, we want to go right to buying. Most lenders will not let you buy the property until you're already there working. So how do we do that? Do we rent for a month and then buy the house a month later or something like that? So there's a lot of timing issues if we're moving to a new area. You could have a job here with your pay stub in Philadelphia and you're trying to buy a house in Oregon with a totally different company. The mortgage lender is going to figure out that, wait a second, you don't have that job anymore, so they're not going to count those old pay stubs. So again, they might have to look at that employment contract because again, it's more future oriented. But then again, they may not let you buy the house until you're already there and working and have a pay stub. So there's some sort of disconnects between the process and the reality. You need to document what assets you have. This is everything from bank statements to investment accounts, even your retirement plans, things like that. You need to provide a paper trail on the bank statements. Why they're looking for 2 months is they want to know that A, this cash is yours, and that you have enough for the closing costs and things like that. You'll hear a lot about gift letters or, oh, mom and dad are helping me and they're going to give me money towards this. So you show a bank statement that shows this, let's say $5,000, $10,000 deposit. The bank or the mortgage company has no idea where that money came from. They want to make sure that you do not owe anybody else. So if they see a deposit within those prior 60 days and it's not a paycheck deposit, the lender is going to want to know where that money came from, and they want to make sure that you don't owe anyone else. They want to be first in line of all the people you owe. This is the reality of it. So if you are getting what's called earnest money or gift money or something like that, a letter from the person giving you the money saying, I, Dad, give son $5,000 free and clear. There we go. We just documented where that $5,000 deposit came from. The lender is perfectly okay with that. For as illegitimate as a little, handwritten note sounds, they just need to document. They now know where that money came from. But that's why they require about 2 months of bank statements. They're looking to make sure that that cash was truly yours. Let's see. If you're going to put a what's called a security deposit, again, I'm trying to buy a house from someone. I'm trying to show them I'm very interested in a house. Say, hey, I want to buy this house from you, and here's a $1,000 deposit. That will go towards the purchase of the house. Sometimes the realtor might sit on it. The person might deposit into an escrow account and so forth. So you are allowed to list that as money up front. We just need to document where it is. They will look at investment statements, things of that nature. So again, we need to document all this stuff. I'm not saying it's a fast process, but as long as we know this stuff, rather than going to a mortgage broker and then them saying, oh, go get me all this stuff, then you have to go home and get it. So I want you to know this up front so you make it a lot smoother of a process. What are your current liabilities? They will run your credit report and they will see the student loans, they will see the credit cards, they will see the car loans and things like that, but they're also going to want you to write it down. So when you fill out an application, you have to actually list your assets and your liabilities. You can't say, oh, it'll all be on my credit report. There's a lot of truth and lending and lying that goes on. So they want to make sure that what you wrote down matches what's on the credit report. They don't want there to be any surprises. So when you list that I don't owe anything, and then all of a sudden they see all this stuff on your credit report, quite honestly. Let's see. Student loans, that's the trap. Banks look at it like any other loan. They think you have a student, they see it on your credit report, they're going to assume you have a monthly payment, yet if you ever sat through any of the financial aid classes, which talk about income-based payments and things like that, it needs to be documented. I work over in the med school, so I'm used to people having $300,000, $400,000, $500,000 of loans. If the bank saw that on a mortgage application, they would assume there's a $5,000 a month payment obligation that that person has. But based on the income-based payments, their payments could be $400 a month. So you have to actually need to document it. If the loan is in forbearance, or we're in our grace period after we graduate, it still shows up in your credit report, yet you don't have a way to prove to them that you have no payment. From a financial aid standpoint versus the mortgage lender. So there's always little disconnects there. Hopefully we don't have $300,000 to $400,000 of student loans. As I mentioned, the credit report, they're going to ask for obviously ID-related information. Certain things don't show up on a credit report. If we have a credit card, that definitely would. The bank, for them to be comfortable lending you new money, they want to make sure that you're reliable with all the loans you've had in the past. So a lot of students might not have a credit card because over the past 20 years, people have heard that credit cards are bad and stuff like that. So a lot of a certain generation is very apt with using debit card rather than credit card. But as a result, there's no credit on their credit report. So it's what's called a thin file. And the language they'll use is they say they need to see 3 lines of credit. You might only have one credit card and that's it. But you've paid rent religiously for the past 24 months, or we've got utility bills or our cell phone bill. That stuff does not show up on a credit report, but you can document that. You can get a letter from your landlord that says so-and-so paid on time the past 12 months or something like that. So there might be, if you have a thin data file, there might be a little extra work involved for the lender to be able to approve you based on that. So typically for students, I do suggest people open up a credit card. Not a lot of them. If you don't have one, I would suggest at least getting one, quite honestly, because we want to get data onto our credit file so that if, yep.
Does 3 lines of credit mean 3 credit cards?
Yes.
It can't mean anything else?
It could mean some other things, like let's say you have an auto loan, student loans, things of that nature, but when they see like really nothing on a credit report, the lender's like, you don't even exist. But definitely at least have one credit card. I'm not saying go open 2 or 3 credit cards, but definitely at least one credit card. We can get documentation to have a landlord. I know there's these ads from, I think, Experian called Experian Boost, something like that, where they say, oh, look, my credit score went up. I think what they're doing there, my assumption, is that they're reaching out and getting utility bills to show up on a credit report, so that would boost a person's score or so forth. Any questions? Yep.
The 3 lines should be in different banks, or lines of credit, or could be in the same bank?
Definitely lines of credit would be the best, but the credit cards.
But credit cards in the same bank? Or
You could have it from the same bank. Like Bank of America has multiple cards. They've got their affinity cards and things like that. What the bank might do when you go to open up a second card at the same bank, they might take some of the credit line off your first card and shift it to the second card. So you don't necessarily have more credit, but you have 2 lines. Think of it that way. Because from the bank, their risk is exactly the same. They took the existing credit they were offering and they kind of split it in half. So you're the same risk customer, but that is a way to get a second line. Yep.
About 2 or 3 slides ago, you talked about a gift letter.
Yes.
If you're going to get gifted or money exchanged, why would you do that instead of signing jointly with survivorship?
This is documenting where the money's coming from. Buying the house, you would receive title to that house, and that's where you could do a joint. But let's say husband and wife, their credit scores are good, their income, debt-to-income ratios work, but they simply don't have enough cash for the upfront costs. And where are we coming up with that? Maybe we're receiving a gift from someone, so there's that source of cash. The bank just needs a letter with that gift saying, you don't owe mom, let's use mom and dad. We don't owe mom and dad this money back. It's a gift free and clear. Because if you don't have the gift letter, the bank says, oh great, where'd this cash come from? You must owe someone else, therefore we'll factor in a monthly payment to mom and dad, and then you can afford less of a house. So an upfront gift, this is just explaining where the money came from to pay the closing costs.
I'm just looking at that with tax implication with the
A gift is never taxable to the receiver.
Yeah, but yeah.
If it's under a certain amount, it's not taxable to the giver either. And there's ways you can split gifts and stuff like that. So again, what's the goal? We want to be a homeowner. We want to be a homeowner as soon as possible. If it takes us a year to save up all that cash just to pay the closing costs, well, if we have a gift, now we can get into the house hopefully sooner. So that's why we would do something like that. Yep. But no, excellent question. Let's see. Now, the property itself, obviously, you come across someone who's willing to sell you the property. You guys agree on a price. The lender wants to see the contract, the agreement of sale. There's what they call a title search needs to be done on that property. The title search definitely protects the bank. It's expensive. It's probably about $1,100 to $1,500, somewhere in that range. It makes sure that the person who is selling the property actually does own it. It'll look back to say, is there any contractor liens against the property? Is there any tax liens, which means the local municipality wants a piece of that property? I could have inherited a property with my two sisters. I go to sell it to you. Well, my sisters own it as well. I might not have told you that little detail. So a title search looks at who actually owns the land, if there's any liens against the property and so forth. The property has to have an appraisal done. You may agree on the price, the seller definitely agrees on the price, but the bank might be, that property isn't worth that much. So an appraisal will be run on the property. Let's see. Do you need to have homeowners insurance, flood insurance if we're in a flood area? If you buy into a condo, there's a whole separate sort of condo documents and so forth. So there is paperwork involved around the property itself. Miscellaneous stuff. Let's say husband and wife go to buy a property joint, but someone can't be there to sign all the paperwork. Well, once you can get a power of attorney so that I could sign for someone or things like that. Could be a separation agreement. The seller, quite honestly, has already moved out, but we need both of their signatures. If we own a property, we need the documentation on the prior property that we own and so forth. So there's a lot of other little things that come up. It's not as simple as, clicking on a website and buying a property like anything on Amazon at this point. Probably will be in a couple years. The home appraisal, again, if someone's going to lend you money to buy it, they got to make sure that they're the ones that actually own it. If you bought it with a mortgage, the bank owns the property. You're simply paying the bank back until you pay them totally off, and then you finally own the property. The home, including the land, is the collateral, essentially. We stop paying on our mortgage, the bank repossesses the building and the land. Now, they would want it to be at least worth what you're agreeing to pay for it, hopefully more, and there's different appraisals that a property might go through. Typically, for a primary home, they're going to look at comparable sales. What did other houses of similar build and quality in that neighborhood sell for? Do you want to pay more than the house next door? Replacement cost, the estimator might say, well, this is a 4,000 square foot property. It's about $80 a square foot to replace something in today's market. Does it fit that dynamic? If it was an investment property, they would look at what income does this property generate and would that justify that price and so forth. So there's different ways that an appraisal will value a property. I mentioned the closing costs earlier. Fine, our credit score is good, our budget's good, we can afford that mortgage, but we still have to come up with the cash to buy the property. The down payment is money we may have to come up with up front. The closing costs, which are the things that the bank is going to charge you, title, insurance, the inspection you're paying for, I'll get into that in a second, the appraisals, the notary fees, all these little ticky-tack fees are on there, and escrows. I'm going to explain that concept. This is money that's put in reserve to pay future bills. You have to come up with it ahead of time. One example, let's say we want to buy a property July 1. Your first mortgage payment might be August 1, it might be closer to September, because the bank still has to file all the documents, create statements, send you a little coupon book with a due date and payment number 1. They're not letting you live there for free from July 1 to September. They're going to charge you 59 days of interest on that loan up front before you actually make your first payment. So that would be one of these escrows. Give you another example. My house, I'm out in the suburbs in Conshohocken, we have about $6,000 a year on real estate taxes. My school tax bill is about $4,900 and it's due every August. You go to buy my property in July, you have to have $4,900 up front in anticipation of that tax bill due within 30 days. You go to buy my property in September, you might only need 1/10 of that amount because you've got 11 more months to build it up. So time of year could play a role in the escrows. Time between the purchase date and your first payment would play a role in those escrows. A lot of the estimates, those quick calculators, you're on Zillow or one of these websites, say, hey, how much is my payment? How much does it cost to buy this property? They'll take the average closing cost in that area. Maybe there's a transfer tax in that area. They'll take some, rule of thumb or whatever. But then at the end of the day, you're always surprised by the escrow number because that number doesn't get calculated until you actually have a closing date and they realize when the first payment would be and when all the taxes are due. So that number always catches people by surprise. Let's see, there we go. We could have someone else pay the closing costs. That sounds like a nice deal. You come to me and say, hey, Mike, I like your house. You're asking $300,000. I'll pay you $310,000 if you give me $10,000 towards my closing costs. I'm the seller. I don't care. I walk away net $300,000, but you magically made $10,000 appear to help go towards those closing costs. Now, granted, you're borrowing $10,000 more than you did, but what was our solution? We didn't have the cash for the closing costs. We might actually overpay a little bit, and we're essentially financing it into the price of the house, but it got us into that house a little bit sooner. So that's what's called seller's assist. The seller helped you. Now, the house had to appraise for way more than $310,000. You can't say, I'll pay you $400,000 if you give me $100,000 back. So there are some guidelines as to how much closing costs the seller could assist with. So again, we can put that into that contract. Let's see what we got. Now you're going to hear the phrase PITI. This is your actual monthly payment. Principal, interest, taxes, and insurance. This is that amount that you're going to send to the lender every month. So how do we get to that? The principal and interest is the actual loan payment. We're borrowing $100,000, we're borrowing $200,000 at whatever interest rate over whatever length of time, we'll calculate how much of that payment is the actual loan itself. Taxes, it could be that yearly real estate tax. Remember I used my example, $6,000 a year is $500 a month. Anyone here from New Jersey? What do homeowners in New Jersey complain about? The real estate taxes. I could take my house in Conshohocken, $6,000 a year. I could place it in Philadelphia, $2,000 a year. I place it in New Jersey, $12,000 a year. Same property. That's $1,000 a month just on this, on the taxes. Insurances. If someone's going to lend you money to own that house, they're going to require you to have homeowner's insurance. If that house burns down, they want to make sure it gets rebuilt. So the homeowner's insurance policy is going to have a monthly amount. That's going to be thrown into the monthly payment. If we don't have 20% on a down payment, I'll talk about this a little bit in the future, there's what's called private mortgage insurance. That's a monthly fee that the lender is charging you because you didn't put a large enough down payment. That's usually that 20% threshold. So that also gets factored in. Now, if the home we're buying actually is part of a homeowners association or a condominium, chances are there's a monthly fee with that as well. So that all gets wrapped into the monthly payment that you send to the mortgage company. Let's see. Yeah, notice how I call these three the escrows. This is the loan. You're paying back the loan to the bank. The rest of the money the bank is collecting ahead of time each month for 12 months. Then all of a sudden you get a bill for your homeowner's insurance, or you get a bill for the local real estate taxes, the county taxes, the school district taxes, or whatever. You simply take that bill and you forward it to the bank. Because the bank's been collecting this money ahead of time from you throughout the year, they pay it. The reason why they do it that way is they want to make sure it gets paid. They're not leaving it up to you to pay. Because if you didn't pay that school tax bill, all of a sudden there's a tax lien on that property, and the bank is no longer first in line. The local taxing authority is first in line to grab that property. So those are what are known as the escrow items when you hear about that. This is the monthly escrow, not the escrow for the closing costs, but this is part of that payment. Now, the debt to income ratio, this is what the bank's going to look at your numbers to see how much of a house could you afford. They're going to look at all your bills, from the housing bills to other debt to maintenance, living it, and so forth. They want to make sure that the housing cost, that PITI payment, is no more than a certain ratio, and we're going to use 28% of your gross monthly income. Not your net monthly income, but your gross monthly income. Then they're going to look at all the other debt that you have. Could be a car loan, could be a student loan. So combined between the housing costs and the student loans or consumer debt can't exceed this other ratio. There's what they call front end and back end. I'm going to use 28 and 43, and you'll see those numbers come up. Theoretically, you're living the day-to-day stuff, utilities, food, fun, whatever, on all the rest of your gross pay. That includes your federal taxes, state taxes, city taxes, things like that. But the house payment and other debt that you have to go within, let's say, 43%. Any questions on this? Because we're really going to dive into this. This is the meat of why a bank would turn someone down or not. You're going to hear, yep.
That's flexible, it's just stated at the beginning when you buy a house, because let's say that you then get a better job and your income is better, so those proportions may change over the time you're paying that credit.
Great point. You're only buying the house once.
Yeah.
You only have to get approved once, so it's based on your data then. Now, you may want to buy a house that's maybe a little out of your price range because you know your career is going to take off and we have extra income in the future, or we're buying a house bigger because we're going to grow into it and so forth. That helps factor into your decision, but the bank only cares about what's your income today. They don't care about the income in the future. They care about what debt do you have today. Now, for example, car loan, if you have a car loan, shows up in your credit report, let's say it's a 5-year loan. If you're within the last year of that loan being paid off, they'll ignore that. They won't factor that monthly payment because they know it's going away. But again, student loans last a long time and other types of debt. But this is only just to get approved to buy the house. And in fact, let's say a year later, your income drops. And theoretically, you would have no longer been approved. Doesn't matter. You've already bought it, signed, you're in it. So it's only really the calculations done up front. You could have a better job, you could have a worse job later on. Doesn't matter, you're into the house. Now, there's different types of mortgages. You're going to hear about FHA, Fannie Mae, Freddie Mac, stuff like that. There's really essentially 4 types. I'm not going to talk about portfolio loans. These are where banks are lending you their own cash and they keep the loan themselves, which means they could have any lending criteria they want. The biggest area is called conforming. It means that the mortgage that you're buying, the qualifications conform to Fannie Mae and Freddie Mac, because chances are that bank that's lending you the money, they got you in, they're selling the loan the next day because they know it's conforming, other people will buy it from them, it meets a certain standards. FHA are guaranteed by the federal government, or excuse me, they're insured by the federal government, so the lending criteria is a little bit looser. You could have a lower down payment, slightly low credit score and things like that. So it doesn't conform to Fannie Mae and Freddie Mac guidelines, but it does come under the FHA guidelines. VA loans, I'm not going to go into much detail today. If you're a veteran, if you're a family member, so forth, we may qualify for a VA loan. There are certain features to that as well. Chances are the mortgage broker, if they're in the business, they would help you navigate across not necessarily the portfolio loans, but those 3 categories, knowing which you would get approved for or not based on your credit score, based on your military service and things like that, and hopefully get you to the right loan. The considerations, between one loan over the other is what would they allow as far as percent down. Let's say we don't have 5% cash for a down payment. An FHA loan could go as low as 3.5%, or a VA loan as low as 0%. So again, that's where the mortgage broker would help you navigate, well, what's our criteria? What are our credit scores? I have an asterisk next to that 500. If our credit score is 500, in order to get approved for that loan, we would have to have a large down payment. We would have to have no other consumer debts and things like that. But you could get a loan at 500 based on those other criteria and so forth. So that would be rare. The debt to income ratios, you can see on the conforming, really they'll say to 36%, but they will go higher as long as there's other elements like a higher down payment, things like that. FHA as high as 43%. The portfolio loans I didn't put up here, I deal a lot with physician mortgages, as high as 50% debt to income. So this is where the mortgage broker, knowing your personal situation, having taken a look at maybe your credit report, could say, oh yeah, we're not into the conforming, so maybe we have to go FHA or something like that. Or if our income or debt has improved over time, we've paid off that car, we've paid down the credit card bills, then maybe we can get a conforming loan or something like that. So there are different types of mortgages. But going forward, I'm just going to use kind of just a general mortgage as an example. So we're going to go with some numbers here just to get you a sense of it. Let's say we have someone who's single, $60,000 a year income, which means they have gross income of $5,000 a month. Their goal is to put 5% down on a property, and let's just say they've got good credit. So it's not that the credit, is a factor, but let's see what the numbers would look like. Let's say they find a house, $200,000. Well, 5% down is $10,000, so they need to have $10,000 cash just for that. Let's assume the real estate taxes are $2,400. Let's assume a homeowner's insurance policy costs $1,200 a year, and let's assume the interest rate on the loan that they got approved for is 4.2%. So that PITI, the monthly payment on just the loan, is $929. The real estate taxes would be another $200 a month. The homeowner's insurance is a nice flat $100 a month. But we didn't put 20% down. So the bank's going to charge what's called private mortgage insurance, or PMI. And I found a calculator to calculate it would be about $123 a month. So the total housing payment in this example is $1,352. The loan itself was $929. All the rest were the escrow items and PMI. This actually plays a bigger role on the total house payment than the interest rate did. Everyone shops based on interest rate, but it's really kind of what else is factored in. And again, this is without a condo or homeowners association fee, which would be on top of that. But what was our rent? What was the equivalent? I mean, I've got 3 kids in University Crossing. Their rent's close to $1,000 a month. Could have bought a townhome instead. So we have to have a comparison to what we're doing anyways. Let's see. What are our debt to income ratios? Remember, this is that $60,000 a year job. On just the housing payment, it's a 27% debt to income ratio, so it meets that front end criteria. But what if this person also has student loan? What if this person has I think the assumption I put in there was a $50,000 student loan? That's showing up on the credit report. The bank is assuming the monthly payment is $500 a month. Yet notice what, the income-based payment, $344. So if we can document that $344, the bank will use that number rather than just a rule of thumb saying 1% of the debt. But what if we also have a car loan? And I used, $280 a month as far as a car payment. That's showing up on your credit report. So if we're about to buy a house and a car, could we buy the house first before this, that car payment shows up? Maybe we get approved for a bigger house because this wasn't factored in, but now we've just committed ourselves to a bigger mortgage payment. So we don't want to, really push the envelope on this because we have to pay that mortgage every month. Worst case scenario, I had a grad sign an agreement of sale to buy a property. The closing date was on a Tuesday. The weekend before, they went into a furniture store. I'll take that, and those. On store credit, which is a new line of credit. It hit their credit report. The lender has an alert on your credit, essentially, saw a new line of credit, made them go back through underwriting. They actually held up the house sale. So don't buy anything. If we're buying a house, after you buy the house, then buy the furniture or whatever. But does everyone understand this? This is kind of the math that the mortgage lender is doing behind the scenes. There's the house payment. You can go onto Zillow and Realtor and you can buy a property or see a property listed and it'll have a estimated payment amount. So you click on that, but you have no idea what assumptions went into that. What interest rate are they assuming? What percentage down? Things like that. But again, that was just this. So you see that, and you say, oh, I can afford that. Well, can you afford that when we know we have this and this? Will the bank lend that to you because they'll see all the other expenses that you have? Now, I mentioned earlier, are there tax advantages? So let's say this, again, same person, $60,000 a year. Let's assume they have student loan. Let's assume they're making at least $2,500 of interest on their student loans, so their adjusted gross income in this case is $57,500. Let's assume they're a renter. At that income level, they would take the standard deduction, which is $12,000, so it gives them their taxable income of $45,500 and taxes of $59,555. So this is them renting. Should they buy a house? Well, for buying a house, they're already paying state and local income taxes based on that job. But now they're paying real estate taxes based on being a homeowner. Those two items, that mortgage I laid out, you'll see $7,900 a month, or $7,900 a year is just mortgage interest. That's deductible. So we had that and that, because they're a homeowner, they're not a renter, plus that they were already paying. Now their itemized deduction is $13,000. We go back to their tax return. They save $396. That's not as dramatic as an answer as you thought it was going to be, but this is where being the homeowner has a tax advantage versus renting in this case. If the numbers were bigger, if their income was bigger, if the house was bigger, if the mortgage interest was bigger, this could be a much bigger number. So again, I have a kind of just one example for us to play around with today. Now, because I'm a tax guy, I always come back to the taxes. A couple years ago, and this is what really caught people in New Jersey hard, is what's called the state and local tax is limited to $10,000. Now, that wasn't the case 2 years ago. State and local taxes would be your Pennsylvania tax, your Philly tax, and your real estate tax. Regardless of how large that number is, the most you can claim now on your tax return is $10,000. So remember, if I took my house and plopped it in New Jersey, what did I say the yearly tax on just the house was? $12,000. That meant I would have been limited to just taking $10,000 on my tax return and ignoring my local income taxes and so forth. So that really, really slashed the tax advantages of being a homeowner. Using that income example, you can see $60,000 a year was paying with real estate taxes about $6,500. But what if, again, we're way into our career, the gross income, let's say, is now $150,000, the state and local income taxes exceeds the $10,000. Now we buy a house and all that real estate tax, it's as if it never impacted it at all. So the tax law changes really, really impacted the buy versus rent decision. It's just not as tax favorable as it had been in the past. Let's say we do go to sell this house down the road. Hopefully it's worth a lot more than we paid. We have a gain. Believe it or not, with a capital gain standpoint, there's what you paid for it, which is the basis. There's what you sell it for. The difference would be a gain or a loss. If we owned it less than a year, it's short term. If it's long term, it's greater than a year. The basis is not only what we paid for it, but all improvements. Again, I've been in my house about 20 years. Replacing the roof, no, that's a replacement. But I put in a pool, I put in an addition, I've actually improved the property. So there's what I originally paid for it plus the improvements is my basis, which means when I eventually sell it, my gain would be smaller from a tax standpoint. So the cost basis is the original purchase plus all improvements. Now, because it is a primary home, if I was single or married, I could exclude from gains a certain amount. So again, let's say we have a $300,000 capital gain on that house. If I was single, I would only be responsible for $50,000 on my tax return. If I was married, all of it would get excluded from the tax return. So the rule is that you must have lived in it 2 out of the prior 5 years before it was sold. So if I'm selling it in 2019, between 2014 and 2019, it had to be my primary residence for at least 2 of those years. It could have been the oldest 2 or it could be the nearest 2. It doesn't matter. So there's little tricks like that. When I had private clients, I had a person that had a vacation property and their primary property. I had them move into their vacation property for 2 years. That was now their primary residence. Then they sold that, got the gain excluded, and then they sold what had been their primary residence because they had lived in it 2 within the past 5 years and got that gain excluded. So a lot of rules to work with here. Now you definitely can't say this. This is my brainstorm last night was to put this number here. Every loan, car loan, mortgage loan, or anything like that, it will create an amortization schedule. So it's interest rate, balance, length of time. Could be a 4-year car loan, could be a 30-year mortgage. A schedule will get created. The monthly payment is mostly interest, a little bit of principal, so your balance actually shrinks over time. Less interest, more principal, less more, and we eventually pay it down. And that last payment is pretty much all principal at that point. That's how every loan works. The reason why I'm bringing this up is, again, this was that $200,000 house, 5% down, so the loan started at $190,000. After 1 month, the balance is $189,735. Why did I say 4 years or more? Because after 3 years, we still owe $179,000 on that $190,000 mortgage. If we had to sell it, we have to pay $179,000 back to the bank. We have to pay $10,000 to $12,000 to a realtor to sell it, and a transfer tax. We had put $10,000 to buy it in the first place in a down payment, plus $7,000 to $13,000 of closing costs, and then $12,000 to a realtor, and we got to pay the bank back $179,000. So did we make money on this property? Did we lose money on it? So the longer we're there, the lower the balance on what we owe the bank. Hopefully more time has elapsed, and hopefully it's worth more. So again, we need to have that 4-year perspective. So the mortgage balance after 3 years is $179,000, but after 5 years, it's $172,000. Again, it's moving down very slow early on. Let's assume the house rises in value 3% a year. After 3 years, that $200,000 house is $218,000. After 5 years, it's $231,000. The difference between what it's worth and what you owe on it is equity. It's an asset. You own that piece. So over time, what you owe is dropping, and what hopefully it's rising in value. So your equity is moving in two directions. The longer we're there, the better off it is. Even if house prices drop or plateau, we've got equity in the property. What if I, instead of selling after 3 or 5 years, decide to rent it? Now my tenant is paying my mortgage for me. The loan's going down, and hopefully it's rising in value. So again, if we have that longer term perspective, it makes it worthwhile. Now the terms of the loan, this is the interest rate, this is what everyone focuses on. The 30-year fixed is going to be the highest rate, because again, the bank's taking a risk of saying, okay, we're going to lend you this money now, even though we have no idea what inflation is going to be over the next 30 years. So they're going to have to compensate for that by charging you a higher rate. Are we going to live in that property for 30 years? So why commit to the highest rate if we're going to move on, when we're starting a family, let's say 5 to 8 years from now or something like that? A 15-year fixed, you'll hear that quoted, will be a lower rate, but it's also a shorter loan. So the monthly payment's going to be much larger. We might not be able to afford that payment. You'll also hear about adjustable rate mortgages, and you might see them quoted with a slash in it, like a 3-1, a 5-1, a 7-1, or a 10-1, something like that. What that means, it's a 30-year loan, so that amortization schedule is built on a 30-year schedule, but the interest rate is fixed for the first number of years, 7 years. And then it goes to a 1-year adjustable after that. Now you're given a lower rate because the bank's like, well, we're only committed to you for the first 7 years. If inflation or interest rates rise, we'll charge you a higher rate in years 8, 9, 10, and beyond. But you're looking ahead saying, I'm not going to be here 8 years from now. I'm going to start that family. I'm going to this is my first job. I want to move back or something like that. So again, why lock yourself into the highest rate mortgage when we can kind of pick the time that we reasonably expect to be there, or have outgrown that house or something like that? If we're renting it out and we hit year 8 or we hit year 11 when the rates adjust, we just charge our tenant more at that time. So use the loan that fits the timing. You should hopefully come across some first-time home buyer programs. These are local municipalities that want to induce people to be homeowners in that community. There might be some requirements to these first-time home buyers, such as that you must attend a real estate counseling type of a course. Obviously can't be a homeowner for a certain number of years ahead of time. There might be a low income requirement, why they're giving you either a tax abatement or they're giving you a low interest, what I call mini loan, to help you pay the closing costs, stuff like that. A lot of times these first-time homebuyer programs might reduce or waive certain closing costs filing fees, things of that nature. But again, if this is your first house and we're looking at a certain area, definitely grill the realtor. Say, hey, what are the first-time home buyers programs available in this area? If they're local and this is their job, is to understand the marketplace, they would know, what you could qualify for or not. The lenders probably won't be up to date on this. So don't expect your mortgage broker to know what deals are available in that local municipality. Because again, they're lending all over the place. But the realtor you're dealing with should know this stuff for you. Now, like I said, this class today was really just to give you enough to be dangerous, get you thinking about your own situation, what makes the most sense for you, married, engaged, are we staying in the Philly area after school? Are we moving? What type of career are we going into? Does that facilitate being a homeowner? Or do we need some portability that renting gives us? So any questions on stuff I brought up? Yep.
First of all, great talk.
Thank you.
I've been blown away by how the information you gave today.
Can you say that louder?
My question is, who or what entity determines appraisal rates? Like, who gives the appraisal cost?
The bank will most likely hire the appraiser. They could do what's called a curbside appraisal. They could look at national databases where someone doesn't even have to leave the office, or they require a person-to-person visit the property and inspect the property, which is like walking in, taking pictures and measurements, things like that. If there's a lot of sales in that area, they could probably do it without even leaving their office. But if there hasn't been, they're going to look boots on the ground. They'll hire someone. There was one thing I mentioned earlier I didn't bring up, was the home inspection. Out of all the steps, title insurance, appraisals, all those steps are to protect the bank, not to protect you. The home inspection is the only step that protects you. You say, Mike, I like your house. We agree on a price, subject to a satisfactory home inspection, requiring no more than $800 of repairs. So you get an inspector, they walk through the property. That inspector's going to give you a nice little book and say, yeah, it's great, structurally sound, but I see water stains, you have a leaky roof, I see cracks in the foundation, I see signs of termite damage. You're walking away from that property. But that same inspector says, everything works, air conditioner's on the fritz. They'd say, I'll suck it up and still buy the property. Or they might say there's a crack in the curb. To get a use and occupancy, the curb's going to have to be fixed. So that's the part of the process that protects you, the buyer. It gives you an out. If something comes up in that moment, and you hire the inspector. The bank doesn't hire the inspector, you hire the inspector. But yeah, it's money well spent. Yep.
How the immigrant status affects?
Say it again?
Your immigrant status. If you're an immigrant, how accessible?
Great question.
For loans or more?
If your credit score's good, you have the verifiable source of income, I think the lender should be fine. If it's, I don't know the nuances between like J1, all the different visa statuses that could play a role. That's a really good question. But other than the numbers, the math, the bank would be fine. It could come back to the visa status, as far as whether they're willing to lend. Because again, the house is collateral. If someone leaves, the bank just takes over the property. They have something that they turn around and sell. They might require maybe a larger down payment. Yep.
Yeah, so I kind of have two questions. The first being, so there's always a lot of talk about when is the quote unquote right time to buy a house, right? Given that our economy is a roller coaster we can't get off of. Is there any truth to this of like, oh, I should wait until the market falls a little bit, or wait to sell? Or is this just like, trying to wait?
Actually, I wouldn't. You have to look at your own personal situation as far as job stability. If the economy was hitting a certain industry hard, you've got military bases closing. There's an event. We've got auto manufacturing closing in a certain town. That would depress the real estate in that town. So it's very local, that type of advice. But over time, if we wait another year, it's another year of paying rent. There's an opportunity cost aspect to it. If we're in a relationship, and we're starting a family, I might say to someone, let's skip the starter home and go right to a longer term home. So I might say, fine, wait a couple years, build up a bigger cash deposit so we can afford that bigger house, knowing that we're going to outgrow the starter home, something like that. But is there a time to buy? No, I'm not going to ever say, yeah, wait a year because I want to wait to see what happens in this area or something like that. If your job is stable, you had to pay rent anyways. So if it made sense to be an owner, it would make sense to be an owner as soon as possible and start building equity. They would that way.
And then, in terms of keeping in mind that it is different based on your locality, is there a certain breaking even point? Is it best to use that the tax, rent, prepare, kind of all these different metrics? So if I'm making X dollars, it makes more sense to rent versus buy. What metric should we?
And part of that, as far as a break even, I don't want the tax to be the deciding point because it is a use item. The 4 years or more was more a case of that's enough time for the property to hopefully appreciate and the mortgage to be paid down enough that if we sold it, chances are we made a profit on it. If we were in 3 or less, who knows? Granted, properties are rising very, very fast over the past couple of years in certain areas. That blows away that rule of thumb anyways. But as far as a break even, there's a New York Times has a buy rent calculator on their website. I think that one's a little bit further out, almost 4 to 7 years, on that one. But it's a fairly robust calculator. I didn't use it as a tool for this talk, but it's a fairly good one. Very nice. Yes.
What is the difference between FHA, VA, and confronting loans?
The conforming is Fannie Mae, which means that the applicant conformed to all the guidelines set. So that anyone across the country, as long as it's a conforming mortgage, they're almost interchangeable. And chances are the bank is simply issuing it. Great, it conforms to Fannie Mae, and we're putting it out the door to sell because Fannie Mae will buy it. The FHA is specific for people that probably couldn't meet the stricter criteria on a conforming mortgage, has a lower down payment, lower credit score, higher debt to income ratio, stuff like that. So up front, if you could afford the conforming, you'll get a better rate. You can still do FHA, but then again, the reason why someone might do FHA is maybe they don't want to put as much up front. They want to get that 3.5% down payment. Now, VA is a separate program for veterans. I don't know the exact criteria as to the eligibility. I know there's you have to be 188 days of active service, things like that. It's no money down. It's a different underwriting criteria because the government is guaranteeing those loans. So that's why they allow it. But any mortgage broker, if you have a veteran, as far as veteran service in your background, and you're talking to a broker, say, all right, could you also do VA loans? And most of them can. And then they would evaluate you based on what's the best loan for your situation.
So let's take up a scenario like that 200K example, for example. So you are doing a 20% down payment, that is 40K.
Mm-hmm.
So you are exempted from your PMI or
Yes.
things like that. And you are a first buyer, so you don't have, and the relator said that you don't need to pay the closing money or nothing like that. They have that option also. So but as a buyer, let's say I have 20K more in my. So is it a good thing to put 60K and take less money as a loan, or just pay that 40,000 and then take the loan?
Personally, I would say do the 40, so that we got the 20% down, no PMI.
Okay.
And if you wanted to, you can pay more faster, but this way it keeps the money on your end. If you put all of it into the house up front, now you don't have anything in the bank.
Okay.
And when's that new car coming? So personally, I always want to evaluate the whole, what's the need for that extra cash. If you have the ability to put, in this case, $60,000, go ahead, because your loan is smaller, your interest rate would probably still be the same. If we had a significant down payment, you might actually get a very good rate. But probably that scenario you gave me, they probably wouldn't give you a better rate, but at least your monthly payment would be smaller.
Okay.
Or the lender would say, hey, we could lend you up to $250. Because you have a larger down payment. The lender gets paid on commission, so they want you into the largest house they can. But if you had more cash, you could go for a larger house. I always want to make sure people have access to that money. Once you put it into the house, you can't get it out initially. But if we didn't need the cash, then I would put the $60,000 down, have a smaller payment.
Or it's a good idea to pay like in the first year of installments when you're paying. Can you contribute towards your principal money, something like that?
Since it's an amortization schedule, every monthly payment pays off all the interest and reduces principal. So any additional dollars automatically go towards principal. Because all the interest was paid that month.
Yeah.
Because it's a fully amortized schedule. Student loans don't work that way, but mortgage and car loan would. I used to sell mortgage prepayment programs, so if you put an extra, $500 a month or something, that 30-year loan is now done in 27 years. It's on the back end. You don't see the difference up front, but it means you're now paid off sooner than you normally would. So I'm a big proponent of prepayment. It's called prepayment. And there are no prepayment penalties, so you can always put extra money.
When you were saying that you can't get the money back out initially,
Yes.
are you referencing the equity?
Correct.
Okay.
Right, but you do have equity in the house, you could go to a bank and get what's called a home equity line of credit. It's basically your equity is now collateral, but you have to have enough equity before they would start to do that. And this example, this $190,000 mortgage on a $200,000 house, we need to get below 80% loan to value and probably 36 months of payment history before someone would give you a line of credit. But you could tap that equity later on, like I said, to put someone through college, to buy a car. Interest rates on cars are extremely low, but they weren't always that way. And you could use the equity in your house to buy that car, or like I said, I put an addition on my house. I use the equity in the house to actually pay for that. So initially, we don't have a lot of access to it.
I have a friend who's a lawyer or in law school, and she was saying that there are loans out there for people who are expected to go into high income jobs. I was wondering if you were familiar with those at all.
I don't know if you saw the slide where I showed the 4 different types of loans. I called that one a portfolio loan.
Yeah.
Those are loans that banks are lending their own money, so they put whatever criteria they want. But they have to keep the loan. It doesn't conform to Fannie Mae, so they can't sell it to someone else. That's where they would make those exceptions. I work in a med school, so we do with doctor mortgages. It's essentially that.
Okay.
Because they know med doctors are an extremely low credit risk, so banks are willing to lend them 50% loan debt to income ratios, no down payment. They're able to do that sort of stuff. So probably not your Quicken loans or Rocket Mortgage for that scenario, because there needs to be more put into it. Because you say, hey, this applicant is going into this career, they know the risk associated with lending, so that would be called a portfolio loan.
Oh, okay.
Yeah. But if you have a banking relationship, it could be PNC, could be a local credit union, something like that, you just say, who's the loan officer?
Okay.
They know, you say, I'm not Fannie Mae, here's my situation, is this bank willing to do this loan? They might. They want another customer, they don't want to lose a customer.
Okay.
Yeah. I think we're good. Sandra, you all right?
I am so good. That was awesome. Very relevant for me. Yeah. How are you? Thank you all for coming. Feel free to hang out if you want. I think we're all good though. Thanks.
Leave that up.